Hi, Matt. Welcome to F.A.C.E. I'm going to make you the presenter, and we'll be able to hear your voice. And there's a screen share option if you want to show some charts. Thank you for taking the time to be with us today. I'm glad I reached out to you on Twitter.
Yes.
Hi, Matt. Yeah, I can, Matt. How are you today?
All right, great. How are you?
Very good. Nice to meet you. We do have a screen share function if you want to show your setup and things that you look at.
Okay.
So,
yeah,
there you go. Okay. So why don't we start with your Twitter handle?
Sure.
The assumption would be that you're a big follower of volume precedes price. What would be your definition of dynamic volume?
Okay, so yeah, I'm the director of research at Kaizen Advisory in Wheaton, Illinois. We're a $250 million RIA, and so the volatility aspect is what. So I work with my brother. We've worked together for the better part of 15 years, and most of that 15 years, yeah, we got our fighting out of the way when we were younger.
Yeah, great, great to have someone, a brother, someone you could trust, and you guys know each other inside and out. And Wheaton, that Illinois is my home state. I grew up in Chicago, but I know where Wheaton is. So.
Oh wow.
Yeah. So
That's
where did you go to college? Did you go to college in Illinois?
Yeah, University of Illinois. So.
Okay. All right. I was in DeKalb in the middle of the cornfields, Matt, and I had no idea I was going to trade commodities. So, so now that you talked about dynamic vol and you've given us a little history, so go back 15 years and tell us the story of how you and your brother decided to start a business, become RIAs, and I also see you have all the certified financial planner license.
The CFA. Yeah.
Yeah. So how did it begin for you guys after you left Champaign?
Okay, yeah, so right I left in 99. Mike was graduated in 99. Mike graduated in 96. He's my brother. And so kind of pretty quickly after that, at the time, VIX didn't even exist as a tradable instrument. So we didn't leave school thinking, we're going to trade VIX products. We both kind of have similar backgrounds. We started on the buy side, picking stocks, at Northern Trust, and Mike was at William Blair for a number of years, investment bank in Chicago, and then I was at InvestNet and sort of doing more research on strategies and mutual funds kind of across the country. And I think what got us into the VIX space specifically was just if probably just happenstance played a large part in it. We started, I started my career at the top of the tech bubble and got to see, some horrible years after that. And then, quickly after that, we got into the housing bubble, and then obviously 2008. In 2008, we had just started in January of 2008. We started at a family office in the suburbs of Chicago, and we helped them kind of get organized, and then they gave us some capital and just sort of a greenfield, what types of, go find something that can make some money. And obviously 2008 got us pretty laser focused on how VIX works. And then pretty shortly after that, the VIX ETFs came out in 2009. And so in that sort of environment is where we came up with, we started using, we built a VIX dashboard, we call it. So it's basically just taking in real-time prices and relationships in the VIX space and trying to point us in the right direction in terms of where volatility in the markets are headed. And obviously we can use that dashboard a number of different ways. We use it two ways.
People have made a fortune over the last few years selling the ECNs, TVIX, VIX-E. Anytime VIX had a pop, and plus there's like this natural decay that happens in these ECNs. Is that the kind of trading that you do? Have you been taking VIX and shorting it?
Sure. Yeah, that's obviously been a nice trade in the last couple of years. But going back farther, if we can get data, starting from the beginning of VIX futures in 2004, and obviously that trade, the short side, has its moments where you want to stay far away from it and actually probably even be long volatility. And so really what we're doing is using our dashboard to just point us in the right direction and tell me whether I want to be short volatility or long volatility, or not play in the market. There's those interim periods.
I'm curious, we're in, well, I'm sure you would agree that we're in some type of melt up that we've seen in the indices over, starting at the beginning of the year. Of course, it started after the November elections over a year ago, but really we got into an acceleration phase. And just something an amateur VIX observer that I am has noticed that the VIX is no longer making new lows with averages making new highs. Is that some type of market message to you with what you see in the VIX?
Yeah, I mean, we're always obviously interested in the trend of just the VIX index, and you're right. It got to levels last year that I thought we would never see. Once even intraday, we had multiple closes. Yeah, I mean, it was just wild, and I think that has something to do with, or probably a lot to do with, some new participants in the industry, the way the VIX calculation has changed, the fact that there are expirations almost, I think, literally daily now in the S&P 500 options that make up the VIX. So there's been some changes, but yeah, in this year in particular, it's been interesting. So far, it seems like, we've had that lift sort of from the 9s to 12 in kind of a grinding fashion up with the S&P. Right. So that's been something that's caught our attention. And yeah, we're looking for, we know how the VIX acts. It's not going to go much lower than 9. Maybe it can spend a second in the 8s or something, but we know on the other side of this, volatility goes in cycles. It's going to be higher as the market eventually enters a bear market at some point. So we're sort of, our job is to look out for that turn and make sure we're on the right side of it. Okay.
Do you see it? Are we in this turn, or what evidence would give it to you? I know people talk about term structure.
Yes.
Where, it's kind of like the old commodity thing where you have backwardation or you just have a premium market. You want to explain that to our community and people?
Sure.
To that later.
Yeah, so term structure is a big part in our dashboard, and probably in most people's VIX trading. It's got to play a role. There's a lot of information in it. It's basically, since VIX is not like other commodities where the reference index, the VIX, is not ownable. So there's no cash and carry arbitrage like there would be in oil or gold or any other commodities. So it's more like euro dollars than it does S&P 500 futures, for example. So the term structure is usually upward sloping. The VIX is usually not spiking and panicking, and then each of the successive, there's 8 months usually at a time, and usually those are in an upward slope. That's kind of the normal steady state, no stress market. And then when you get an event like Brexit or something more sustained like a 2008 or the debt downgrade in 2011, you'll see the curve go backward and as the VIX lifts up. And that's just the VIX futures telling you that eventually things will get back to something more normal. But in the here and now, there's a little demand for hedges. So
right, because I started to hear people buying insurance for the past few years. They've stopped doing it because they go, what for? It's just been a waste of capital.
Right.
Right. Yeah. I mean, we all buy insurance hoping we don't need our, homeowners for a fire or health insurance for a health crisis. But people have gotten to the point where they weren't looking at it as buying insurance. They were just saying, why even spend the money on, if anything happens, I don't need health coverage. I'll go to the emergency room.
Right. Yeah. You see a little of that. I mean, I literally saw an article from the Journal a couple of weeks ago. I think I posted on Twitter that said almost exactly that. I interviewed a couple fund managers in some capacity that just basically said, we're not buying puts anymore. It's basically just a drag. on performance. And, you know, I guess the assumption there is that the market is just going to keep going up and to the right forever, but that's a interesting one.
I sense you have a different view. That,
yeah.
So go ahead, tell us what you're seeing now, and you know what you're advising your clients to do, if you can,
right,
compliance-wise. How are you positioning yourself with the S&Ps up around 2,800?
Right. So I mean, we're not looking at the, you know, sort of an imminent decline or anything. We're not positioning that way, but in the big scheme of things, you know, we're 9 years into an expansion, rates are rising. You've got more leverage in the system than has ever existed. And so, you know, we're just trying to be cognizant of that. Right now, obviously, clearly the trend is up for the S&P and down for volatility. We're starting to see potentially a little turn in the trends in VIX and some of the vol futures. And so I think on the broader scale, we're looking at basically rates. Which way are rates headed? How fast are they moving higher?
Yeah, it must be a mind reader, because I was just going to ask you with what the 10-year's been doing, which is nothing compared to what 90-day T-bills have done. They've tripled. So go from 0.5 to 1.5. Do interest rates come into play as far as the price structure of VIX, financing them, or anything like that?
Yeah, so I mean, VIX has become like this worldwide proxy for risk, and I think we've seen a lot of, especially in the last few years, as VIX has become more mainstream, the VIX products have, we've seen some crossover buyers from, you know, like the high yield market. We saw that in the first time oil really cracked, I think it was 50 in 2014. Yes. And the high yield market the spread started shooting up, and we saw some buyers from that market coming over and hedging in the VIX. And so before the S&P really had any issues, you started to see the VIX pop in that December period. I think it's all of these issues. So rates, you know, I guess oil, you know, would be another big macro factor, but to us, it's more, and to the VIX, I think responds more to the rate of change. So it's not so much a level. So the 10-year today, I'm looking at about 265. It's gotten up there. It's gotten from 240 to 265 pretty quickly. I would expect that, you know, at this pace for another, if you see it shoot to 3 quickly, you might just start to see some equity weakness. You'd start to see VIX start to lift, I would expect. So we kind of keep.
You know, I took a look at the chart, and basically the range has been, you know, 1.3 for a low, 2.6 was resistance, I don't know, about 8 months ago, and we're there. That if you consider a breakout over 260, it measures up towards 390 or 4% is actually the technical target of what's going on there. But you think that the market, especially with these valuations, are going to start to feel it at a 3% big round number?
Yeah, I mean, again, it's if they have time to adjust to 3%, you know, over the course of 6 months, say, that's a different story. You know, again, our background going through 2 bubbles and crashes, they were sort of set off by rising rates, and if the rate rise is quick enough with this much leverage, I mean, you have to assume that people have made some rosy assumptions with using leverage, and so that, you know, we're just looking for something that would kind of start the trend going the other way.
Okay, and so I'm sorry, I didn't mean to interrupt you.
Oh yeah, and so, you know, that's what we're looking for in very, you know, short term. What we look at though is the term structure and the short term trends in volatility. So really, what we're doing now is we're shorting the front end of the VIX curve, just based on the term structure. So there's decent decay there. We're doing it in smaller size, and we're kind of pairing that with some longer term long volatility, and so our long vol positions are in the deferred months, and that is kind of our.
How far out?
So we're in the ETFs. We're using that VXZ, which trades in months 4 through 7. So that's right now it's kind of the summer months, And the idea there is that's kind of our macro trade for the turn. If rates want to keep rising, if the Fed hikes 1 or 2 more times this year, you could, I think that is probably a lower cost way to kind of get ahead of that turn. At the same time, we can kind of sip at the decay in the front that's happening on a monthly basis.
Before we get away from rates, do you take into account the yield curve and the way it's flattening? And do you think there's a possibility, if the Fed continues embarking on this tightening campaign, that we could invert, because we know an inversion is usually not a great sign for financial instruments? So what do you think?
Yeah. I mean, we don't explicitly incorporate it in terms of like a formula or anything, but it's definitely something that we're watching in terms of just the larger macro picture. And yeah, you're right. An inverted curve, it's not a great timing signal where you would want to jump all over a long ball or a short VIX position or a short S&P position, but it's something that, again, in that longer, bigger cycle, we want to make sure we're on the right side of that. So
okay, so why don't you give us a quick tutorial on your VIX dashboard? Are we looking at it right here? Is that
so we can pull that up. It's basically, there's a number of things, but so really what concerns us day to day, obviously here's the VIX curve on the left here. I want to see an upward sloping curve and a very low level like we see today is an indicator basically that there's very little stress in the market. And numbers like, I mean, the whole curve, up until recently, the whole curve was under 15. This is the 6-month contract, still under 15. Historically, really low number. I think the median VIX going all the way back to 1986, the predecessor to VXO index, this is still way below median even at 6 months out. So the extraordinary kind of confidence in by the market that there's nothing going to happen over the course of really many months now. Suffice to say, though, we look here. This type of market is a good environment to own the inverse VIX products because those basically will decay as these futures kind of pull in towards the spot VIX index. And so the dashboard monitors this relationship, to start, and then we also look at things like realized volatility in the S&P 500. How volatile has the S&P been in actuality? And that's actually been very low too. So we sort of look at that as, the difference between the VIX index and the S&P's realized volatility is kind of a PE ratio almost for the VIX. So that has some value to us. And that's this difference down here. You can see this, the little blue mountain here is the realized volatility. It's almost off the chart. So it's, very low in the 6-7 area right now on a 10-day. And the blue line right here is the VIX index itself, which is up about 11.5 today. So that's a nice spread there. That tells us that VIX is actually maybe even a little overpriced on that measure.
So let me ask you about your a little bit here, man, because what you do is pretty unconventional for most RIAs. Most RIAs, they're just, they're in equities, or, they'll do, the old, certain percentage bonds, certain percentage cash, certain percentage equities, and you're actually trading, taking positions in what's a pretty exotic instrument. Do you have to go through a different type of process of awareness, making your clients aware that this is your strategy, and it's not typical for an RIA? Am I wrong?
No, you're right.
Would not do anything like this that you're doing?
Yeah, you're right, and I think that's our background is kind of a hybrid between traditional sort of buy-side equity type models, which RIAs are heavily invested in, and then through the course of our careers, we got CFAs. The fundamental stock picking side is where we started, so we can speak that language when we understand what RIAs are going after there. And then over the course of, really, it was in that 2008 period when we left that family office, we took our VIX strategy and went to the prop trading world in Chicago and traded it for a division of EDF Man's balance sheet.
Okay.
And so that is complete opposite end of the spectrum from CFA fundamental research on stocks. So kind of combine the two. And
you and your brother are Mavericks.
Yeah, we're wanderers. Yeah, sure.
So go ahead.
Yeah. So, we kind of have a foot in both worlds, the trading kind of quant world as well as the fundamental world. And then at Kaizen, we sort of married them back up, and we're trading a quant type strategy that is really futures based. We're trading it using ETFs and brokerage accounts that are very familiar to RIAs. And so our pitch to them is really just the portfolio effect of adding a VIX, a non-correlated strategy like this inside stocks and bonds portfolios really helps an RIA's business.
Interesting. Okay, so this would be a good time to show your website if you want to do that, and maybe talk about account size minimums, if what people would need to get started with you.
Okay, yeah. So at Kaizen, I mentioned we've got 250 million under management. The bulk of that right now is in 3 mutual funds, and so our web presence right now is on the mutual fund side, and that's kaizenfunds.com. I'm showing you here, and on here you're just going to see the 3 mutual funds that Kaizen manages. Very shortly, we're going to have on the RIA side some information about the VIX strategy in particular. So if you'd like to contact me, probably the best way to do that is either through Twitter at Dynamic Vol. You can message me there, or my email is matt@kaizenfindist.com. So Kaizen, FINDIST.com.
Do you have an account minimum?
So account minimums are very low. So the VIX strategy, we call it Alpha Seeker, and account minimums. I'm going to pull up a tear sheet here if you don't mind. There we are. So this is the VIX strategy, and these are live returns for going back 6 years, and the account minimums here are very low. We can do, technically down to $10,000. Trading, these are all separately managed accounts at TD Ameritrade, and TD's ticket for an equity trade is $4.95 now, or actually $6.95 through our setup.
Right.
And so the bigger the account goes, the cheaper it's going to get for trading. So really, probably 50,000 is more practical.
Okay, nice performance.
Yeah, thanks. It's been a great environment type of trade, especially in the last 2 years. Has been really good. It's been actually a really smooth ride, which is an odd thing in the VIX usually. But yeah, there's beyond just the numbers. I think the way the correlation works with stocks and bonds over time, and those periods when we can be long volatility is really where the benefit of the strategy comes into play for an RIA. And I think that's why we keep looking forward to the next sort of an actual volatile market.
You're looking forward to gravity?
Right. It's going to come at some point. We know, maybe not. Maybe the Fed can keep this going forever, keep the plate spinning forever. But we're not planning on it.
Yeah. Well, Matt, I want to thank you so much for taking the time, and really a very interesting presentation. And you definitely are a hybrid from the RIA industry. Great performance, and anyone who's watching us live now or sees the video later, I think it's something that they could consider. Are they able to do this in their retirement accounts or only in after-tax accounts?
Yeah, retirement accounts. It's actually probably a better vehicle, because this does spit out some short-term gains, so there are some tax considerations here.
Well, thank you so much, Matt. I wish you and your brother a great 2018. I know when you get a hold of me, when you see something happening where the VIX is going to move, we'll have a moonshot. I think we could see 40 to, who knows, again, once it's going. So appreciate your time, and wish my best to your brother, because you're both, like it or not, now my trading warrior brothers. If you would have just been a straight RIA, I would have just said thank you. But you guys have trading mentality, So you're definitely, we're cut from the same cloth, from the same state, and I wish you nothing but success.
Thank you, Dale. You too.
All right, buddy. All right,
Okay.
guys. Thank you. You can get a hold of Matt Thompson, Twitter handle @DynamicVol. And Tom grew up in Lombard. All right, all you Illinois boys, that's a wrap. Remember, don't just count your pips, count your blessings. See everyone tomorrow for Turnaround Tuesday. Adios. Thanks again, Matt.
Thank you.